Wall Street plunged for a second straight day, forcing all three major U.S. averages to give up their 2015 gains and causing the Dow to easily enter correction territory. The Dow Jones Industrial Average tumbled 530 points, or 3.11% to 16,462. The S&P 500 shed 64 points, or 3.17% to 1971, while the Nasdaq plunged 171 points, or 3.52% to 4706. Technology and energy stocks took the biggest hit during the session, with the respective sectors dropping 4.21% and 3.48%. Today's markets. The intense sell-off on Wall Street forced the Dow and S&P to shed 5% for the week, with the Nasdaq declining nearly 7%, as traders across the globe worried about sustained weakness in China. The report on Chinese manufacturing showed activity shrank at the fastest pace since 6.5 years, evidence that the world's second-largest economy could be in for a sudden slowdown. The dismal manufacturing figures from China leave the door open for more devaluing of the yuan. Throughout the past year, China has been very aggressive in its stimulus schemes, but they still aren't enough to sustain high levels of growth, David Madden, IG market analyst, said in a note. The only option for Beijing will be additional monetary easing, which will effectively put the brakes on the U.S. recovery. The intensified worries about China's economy came after the latest meeting minutes from the Federal Reserve showed central bankers in the U.S. were more cautious about when to high short-term interest rates for the first time since cutting them during the 2008 financial crisis. Speculation on Wall Street had been for the first hike to come at the Fed's next meeting in September, but increased worries about the persistent low inflation in the country could push that timeline back to December, or possibly even into 2016. The moment Yellen drew the line in the sand that rates will move this year, almost to the day, that's when markets started their move lower, Peter Kenny, chief investment strategist at Clearpool Group, said. That's the parallel story that's driving the reorder of asset allocations away from risk. As the sell-off gained momentum, so did investor anxiety. The CBOE VIX index, Wall Street's so-called fear gauge, surged 118% for the week, the biggest weekly gain ever, notching the highest close in nearly 4 years. In a sign of the breadth of the sell-off, U.S. stocks have shed nearly $1 trillion in market cap since the move lower began on Tuesday. On Thursday alone, U.S. equities lost some $475 billion in market value before shedding $371 billion on Friday, according to the Dow Jones U.S. Total Stock Market Index. Selling pressure that intense, causing the DJIA to drop more than 300 points for 2 consecutive sessions, hasn't happened since November 28, 2008, the height of the U.S. financial crisis. Kenny said for investors the question now is, when does the free fall stop? Very few investors see this pullback coming to a sharp conclusion anytime soon, he said. We haven't had a 10% correction this year, and this will likely be it. He continued that while the sell-off is China-centric to an extent, there are also a lot of other factors weighing on sentiment. Concern over global growth is number one. Number two is the impact that will have on emerging currency wars, and that's why this is a global story, not a U.S. equity